Okay, so we go now to the part 2 of our module 2. This is still in pricing and profitability analysis. Okay, so we still have the same overview in the first part in 2.A. However, for our learning outcomes, so at the end of this module, you should, number 1, be able to compute sales price, sales volume, contribution margin volume, sales mix, market share, and market size variances. Okay, so and for the second learning outcome is for you to discuss the variations in price, cost, and profit over the product life cycle. Okay, for the content of this part of the module, we will be discussing about the analysis of profit-related variances and the product life cycle. Okay, so to start, the first topic is about analysis of profit-related variances. So in your cost control and management subject, you might as well have taken up the topic about variances. Okay, the difference between the budgeted and the actual production or sales. Okay, so here managers frequently want to compare the actual earned with expected profit. So this leads to variance analysis because basically actual and expected or budgeted figures are different. Okay, so in which actual and budgeted amounts will be compared. So the difference is what we call variance. Profit variances center on the difference between budgeted and actual prices, or it can also be in terms of volume, difference in volume, and contribution margin. So for the first analysis, we have what we call sales price and sales volume variances. So in this variance analysis, we focus on the selling price and the sales in terms of units. So the difference between the actual price and the expected or budgeted price, and the sales or the actual sales volume and the expected or budgeted sales volume in units. Okay, so actual revenue may differ from expected revenue because of the differences in price from the actual and expected prices, or because, as what we have mentioned, of the quantity or the number of quantity sold, okay, from the expected quantity, or both the price and the volume differences. So here, for the sales price and sales volume variance, or for the first variance analysis, for the sales price, first we will focus on the price difference. So this is the difference between the actual price and the expected price, and the difference will be multiplied with the actual quantity or volume sold. So the equation form is as follows. Okay, this is also the same as what we have described. So next, for the sales volume. So this is the variance in terms of number of units. So this is the difference between the actual volume sold and the expected volume to be sold. And the difference will be multiplied by the expected price. Okay, so this is our formula. Please take note of that. Okay. What about for the overall sales variance? When we say overall sales variance, this already comprises the combined difference of the price and volume. Okay, so the sum, or this is the sum of the sales price variance and the sales volume variance, or overall sales variance, as mentioned. Okay, so here please take note, the variance is labeled as favorable, or F, if the variance will increase profit above the amount that is expected. And on the other hand, they will be labeled unfavorable, or U, if the variance will decrease the profit below the amount expected. Okay, to understand better the concept of sales price and sales volume analysis, variance analysis, we will take this example or illustration. Okay, so for Armor Company, they distribute and produce, okay, their products. In May, the company expects to sell 20,000 pounds of produce at an average price of $0.20 per pound. So the actual result is 23,000 pounds, and they are sold at an average price of 0.19 per pound. So the requirements are the following. Number one, we will calculate the sales price variance for the month. Number two, we will calculate the sales volume variance. Number three, calculate the overall sales variance and explain why it is favorable or unfavorable. Number four, what if May sales were actually 19,000? So how would that affect the sales price variance and the sales volume as well as the overall sales variance? Okay, for the solution, our sales price variance using our formula that is presented earlier. So here, it resulted into an unfavorable variance. Why is it unfavorable? Because in this case, the actual price is lower than expected. The company expected to sold this produce at 0.20. However, they actually sold it for only $9.19. That's why this variance in price is considered to be unfavorable. Okay. What about for sales volume? Okay, so our actual volume of sales is 23,000 and the company only expects 20,000. So meaning to say, there is an increase of 3,000 in the actual sales. So that's why the variance is considered to be favorable. Okay, so because it has the effect of increasing the profit. For the overall variance, all you have to do is just to add the two variances. So here, since we have 230 unfavorable, we will deduct it from 600 favorable variance in the sales volume. So here, the overall or net sales variance is 370 favorable, because in this case, we have a larger favorable variance figure of 600. So, for number 4, if the May sales is in pounds were only 19,000, so of course, we will expect that there will be a decrease in sales price variance, the same as well, because in this case, the prices did not change. So we still have an unfavorable variance. Since the actual also decreased, then there will also be an unfavorable sales. In this case, unfavorable sales variance, because expected volume is 20,000, but the actual is only 19,000 units. So here, the overall variance will also be unfavorable. So you can also compute for the figures of that, okay? But this will be its effect. Okay, so that's for the analysis of profit-related variances in terms of sales price and sales volume variance. So we go now to the second type of variance analysis, which is contribution margin variance. Okay, so here, contribution margin variance is the difference between the actual and budgeted contribution margin. Okay, so that's simple. However, in this case, of course, we will just might as well prepare the contribution margin format income statement. So to apply, we will use this illustration. So we have here Birdwell Incorporated. So they produce and sell two types of bird feathers. Okay, so they have the regular type. Okay, and this is a simple plastic and wood model which can be hung from a tree branch. And the other one is the deluxe model, which is larger, can stand alone, which includes a post and a round squirrel shield to prevent squirrels from eating the bird seed. So budgeted and actual data for these two models are shown. Okay, budgeted for the first table and the actual amounts in the second table. So based on the data provided, so you are required to calculate the contribution margin variance. And number two, what if actual units sold of the deluxe bird feather decreased? So what is the effect of that on our contribution margin variance? What if the actual units sold of the deluxe bird feather increased? So what is the effect of that also on the contribution margin variance? Okay, for the solution, so for the first requirement, our contribution margin variance is just the difference between the actual and expected CM. So here we have favorable variance of 875 because the actual CM is greater than the expected CM. For number two requirement, if units sold of the deluxe bird feather decrease while everything else stays the same, so our CM variance would also decrease. Of course, it follows. So whether it turned unfavorable would depend on the amount of the decrease in our sales for the deluxe. On the other hand, if the units of sold of the deluxe bird feather increase while everything else stays the same, of course, it also follows that the CM variance would become larger and still be favorable. So we can describe it even without calculating the figures. Okay, so that's for the contribution margin or CM variance. Okay, next is contribution or CM volume variance. This is in terms now of the number of units. Okay, so the CM volume variance is the difference again between the actual quantity sold and the budgeted quantity sold, and we will multiply it by the budgeted average unit contribution margin. So this variance will give the management information about gained or lost profit due to the changes in the quantity of sales. So here, this is our formula as mentioned earlier. So the budgeted average unit is the total budgeted contribution margin divided by the budgeted total number of units of all products to be sold. Okay, in addition to the formula. Okay, so to apply this variance analysis, we will use this illustration for Birdwell Incorporated still. So the same, they have two types of bird feathers. Okay, and we have the budgeted and actual sales in units and the total contribution margin. Okay, for the requirement, so first you're going to calculate the budgeted average unit CM. Second, we will calculate the contribution margin volume variance. And number three, what if actual units sold of deluxe feather decreased? So what is the effect of that in our CM volume variance? What is the actual units sold? Or what if the actual units sold of the deluxe feather will increase? So what is the effect of that also on our CM volume variance? Okay, for the solution, so we have number one, budgeted average unit margin is, all you have to do is to divide budgeted total CM by budgeted total units. So that's $6.75. For number two, our CM volume variance following the formula that we have presented a while ago. So we have an unfavorable variance of $843.75. Okay, number three, if the actual units sold of the deluxe feather would decrease while everything else stays the same, so the CM margin volume variance would also decrease and become even more unfavorable. Of course, that is expected because our actual units have decreased. So what if actual units sold for the deluxe bird feather will increase? So here, our CM volume margin variance would increase. of course, and it will become less favorable, or depending on the increase, it might be favorable as well. So whether it turned favorable would depend on the amount of the increase. Okay, so that's for CM volume variance. Okay, so the next variance is sales mix variance. Okay, so normally sales mix variance is applicable for uh, the multi-product setting. Okay, if you could still remember in our CVP analysis. Okay, so sales mix represents the proportion of total sales yielded by each product. So a company which produces only one product has sales mix of 100%, of course. So multi-product firms will experience shift in their sales mix. So if relatively more of the high profit product is sold, profit will be higher than expected. So if the sales mix shift toward the low profits, of course, our profit will also be lower than expected. So for the sales mix, okay, this is the sum of the change in the units for each product multiplied by the difference between the budgeted contribution margin and the budgeted average unit of contribution margin. So for the sales mix, if you could notice, our formula is quite long because of course we will consider each type of product. So again, this is for a multi product setting. Or the company is uh, offering more than one type of product. So that's why if you could notice in the formula, we have product 1, product 2, okay, and more, and so on. But again, the idea is that this is the change in units for each product multiplied by the difference between budgeted contribution margin and budgeted average unit contribution margin. So to understand better and to apply this sales mix variance analysis, we will use Bird well incorporated illustration again. So here, the sales units, unit CM, and total CM are provided. For our requirement, so we have number 1, you're going to calculate the sales mix variance. Number 2, what if units of the deluxe bird feather decreased? So what is the effect of that in our sales mix variance? So what if the actual units sold of the deluxe bird feather will increase? So again, what is the effect of that on our sales mix variance? Okay, for the solution, so sales mix variance using our formula. Okay, so the answer is favorable. Okay, variance of 1,718.75. Okay, so all you have to do is just replace the values, okay, and use it in our suggested formula for sales mix variance. Number 2, if the actual units sold will decrease while everything else stays the same, so the result or the effect for the sales mix variance would also decrease and become even less favorable, or depending on the decrease, it might as well become unfavorable. If on the other hand, the actual units of the deluxe will increase, then of course our sales mix variance would also increase and become more favorable. Okay? So here, the favorable sales mix variance of 1,718.75 combined with our unfavorable CM volume variance in the previous discussion. This explains actually the overall favorable CM variance of 875. So please refer to the previous illustrations that we have. Okay, so the next variance analysis is the market share and market size variances. So here, managers also want to look outward to see how their company is doing compared with the rest of the industry, okay, that they are in. Market share gives the proportion of industry sales that is accounted for by the company. Market size is the total revenue for the industry. Clearly, both market share and market size have an impact on the company's profit. So again, when you say market share, this is the percentage of um, share of the company, okay, in comparison with the other competitors with the same industry. So market size is the total revenue for the industry. Okay. So how much of that is accounts for the enterprise. So the market share variance is the difference between the actual market share percentage and the budgeted market share percentage, and will be multiplied by the actual industry sales in units times budgeted average unit contribution margin. So this is our formula. Okay, so the market size variance is the difference between the actual and budgeted industry sales in units times the budgeted market share percentage times the budgeted average unit contribution margin. So this is our two formula for market share and market size variances. Okay, so to apply this variance analysis, we will use again Birdwell Incorporated as an for an illustration. So here, budgeted unit sales for the entire bird industry are given. That's 20,000 for all model types. And actual unit sales for the industry is 23,000 units. Units sales in units for each item. Total CM and budgeted average unit CM are also provided. Okay, for the requirement, first we will calculate the market size or market share variance. Second, we will calculate the market share variance. Market share, and market size, I guess. Okay, so this is a typographical error. Number 2 is the market size. Okay, number 3, what if Bird will actually sold a total of 2,300 units? Okay, that is the total for the two models. How would that affect the market share variance and the market size variance? Okay, for the solution, so market share variance using our formula that is presented. Okay, so of course, first we will determine the actual market share in percentage. So that's the actual or sales in units. Okay, and then the budgeted market share. So this is also provided in the data. Okay, so all you have to do is to add for these two items or models. Okay, so our market share variance is unfavorable. Okay, 2,869. So the variance is unfavorable because our actual share of the market is less than the budgeted. So our actual market share is 8.152%, while our budgeted market share is 10. Okay, so lower actual market share. That resulted into unfavorable market share variance. For number 2, market size variance. So here, using the formula, it yielded into favorable variance of 2025. So the reason behind this is the actual number of units sold is larger than the number of units expected to be sold in the market. So here the actual sales is 23 and the budgeted is just 20%. Okay. For the third requirement, if Birdwell actually sold a total of 2,300 units, then the actual market share percentage would be 10%. Okay, that is exactly equal to the budgeted market share percentage. Okay, so here the market share variance would be 0 because it's just the same. So there would be no impact also on the percentage of their market size. Okay, so that's for the market share and market size variances. So we go now to the second topic under this module. So that is product life cycle. Okay, so here, the product life cycle describes the profit history. So of the product according to the four stages. I don't know if you have encountered this topic before in your management subject, product life cycle. So we have the introduction stage, the growth stage, maturity, and the decline stage. In the introduction phase, the profits are low because number one, revenues are low as the products gains market acceptance. Because in this case, we have the what you call that we have introduced first, okay, our product, so there is no um or there are, if even if there are potential customers, but the acceptance of and patronage of the consumers is not yet guaranteed, so that's why revenues are low. Second, investment in learning is higher. Okay, so of course you have to invest more in the beginning part of the product life cycle, so of course that will lead to higher expenses. Okay, for the growth stage, this is characterized by increasing market acceptance already and sales. So, as well as economies of sales, meaning to say your market sizes are growing, which bring down our expenses. So, the product breaks even, and there is also a possibility of rise in the profits. In the maturity phase, profits will stabilize. So, here the product has found its market and revenues will be stable. Investment will be low, and all learning effects in production will be realized, and that will lead to stable costs. Finally, in the decline phase, the product reaches the end of its cycle. So revenues and profits will now decline. So this is actually the application of the law of diminishing returns. Okay, so meaning the product will reach its peak point, and after which, okay, there's no where to go but to go down. Okay, so cost may still be low but not enough to slip below the sales. So the product life cycle will help the firm understand the different competitive pressures on a product in each stage. So thus it is important in the planning purposes. So that's how important is the identification of the product life cycle. So the regularities in product manufacturing, cost and profit make the product life cycle just as important in the cost management. So each stage of this product life cycle demonstrates predictable impact on various types of cost. Okay, so if you could still remember, as the stages change, the cost also changes. So it may be lower, higher, and so on. So the product life cycle depends on the product and the environment also that it faces. So here we have the in the table the impact of the product life cycle on the cost management. So for this table, for the product, so during the introduction, basic design, few models. In the growth stage, some improvements already, and there is also expanding of product line. For the maturity, there is proliferation now of product lines because they are now learning, and the product has found its market and becomes extensive, and they can apply differentiation on the products. For the decline stage, of course, minimal changes. There will also be reduced in the number of product lines because some might as well be closed. For the learning effects, okay, so it follows. What about for us setup? So few but new and unfamiliar for the introduction stage. For growth, more and new models are introduced, meaning to say more costs. For maturity, may be high depending on the line changes and additions. And for the decline, of course, fewer suppliers and orders, and inventories will actually be liquidated. For the marketing expense, in the introduction stage, that will be low selling and distribution cost. Okay, for the growth, increased advertising. For the maturity, we only have supportive advertising, but we can also incur other expenses like trade, discounts, and high distribution costs. For the decline stage, of course, we have for the decline stage, we have minimal and uh, minimal advertising and distribution as well as promotion because now we are closing, okay, some of the product lines. So the product life cycle has implications for ABC or activity based costing. So here, under the ABC costing, we have the unit level, batch level, product level, and facility level. So here, when we say unit level cost, these are highest in the introduction phase because new materials are sought in small order quantities. So small order quantities means a higher carrying costs and without discounts. Direct labor is also high because here labor learns how to manufacture in the new item. So there is no learning process yet, or the learning process has just started. Okay. For unit level cost, it begins to fall in the growth phase as learning takes effect and quantity discounts on materials may occur because we may now purchase more units. So the maturity phase should lead to stable unit level costs. In the decline phase, with fewer units produced, does not enjoy quantity discounts, but unit cost may remain low due to the liquidation of our inventories and the avoidance of increasing profits. Okay, unit level begins, batch level costs follow the same pattern as in the previous, okay, for the unit level. Purchasing, receiving setup, and inspection are high. However, in this case, in the introductory phase, due to unfamiliarity because we are just new in the market, in the growth phase, batch level costs should decrease because of the positive income of the learning process that occurred. So in the maturity phase, batch level cost may increase as production and differentiation occurs, of course, because of the different processes that is now being employed into production. Setup number and complexity will also increase, purchasing orders will rise, and inspection cost will now also be increased. For the declining phase, our batch level cost again will fall. Of course, we expect that under this stage. So, because product lines are streamlined to just or lessened to just few best-selling lines in batches. So, the number of and complexity will also decrease. Okay, for product level cost, highest in the introductory phase also, and generally will fall throughout the rest of the life cycle. So with possible spikes upward for new models in the maturity phase. Facility level. Okay, this cost may or may not affect unless the product call for a new facility or equipment. Okay, then they are highest in the introductory because this is just the stage where we actually invest. Okay, so the table here summarizes what we have just discussed. Okay, for ABC categories. So product life cycle are here. We have limitations. So this is actually the overall limitation for profit measures. Okay, under this module. Number one, profitability analysis is focused on the past and not in the future performance. Okay, because we base it on the historical data. The companies must remain flexible and be aware of the changing business conditions because economic environment is adaptive to change. They are always changing. So number two, profits emphasis on quantifiable measures. Some aspects of profit are qualitative, not only quantitative. So startup companies may be thrilled to have made it in the past 1 year. Okay, so they mark celebrations of anniversaries. The confidence that comes with being able to successfully start and continue a business is part also of their wealth. So many companies give back a portion of their profits to their communities in the form of their social or corporate social responsibility. This too is a form of wealth for them. So this is qualitative. Number three, profit has a strong impact on people's behavior. Okay, so predictably, individuals prefer profit over loss. Okay, that is obvious. Their jobs, promotions, and bonuses may depend on the annual profit. And this dependence also can affect their behavior in expected and unexpected ways. So, as accountants, it is important for us to realize that profit measurement can lead to different incentives for individuals to work harder or to act ethically. Because again, as mentioned before, profit measurement will also help the management in determining the performance of the division, the managers, and so on in uh, providing benefits or punishing them for not doing well. Okay, so that's for the second part of our module 2.B. And for our references, I've taken the contents of this module from these books. Okay, so this is the end of our module number 2.